Welcome to the part 2 of chapter 7. So in this part we will discuss about the subsequent valuation of accounts receivable. So let's start. So the being entitled to receive payment doesn't mean that seller will be paid. So credit losses, meaning bad debts, are an inherent cost of granting credit. How should we account for the fact that not every account receivable is likely to be collected? So there are two methods. The first one is the direct write-off method, and the second one, allowance method. Say for example, if you sell products of 100 million, out of these 100 million, so you are more likely to receive 95 million. Okay, so the remaining 5 million may not be collected. Okay, and now the question is how you will be recording this 5 million. Okay, so this is the question. So some accountants may record directly that this amount of money, meaning this $5 million, will not be collected, and we are directly writing off, but this is not supported by GAAP. Okay, so in this case what you can do, you can just create an allowance for uncollectible accounts, and then after some time you will be waiting, and then you will decide whether you should write it or not. So the direct write-off method is not supported by GAAP. So the two shortcomings are overstates the balance in accounts receivable in the periods prior to the write-off, distorts net income by postponing recognition of any bad debt expense until the period in which the customer actually fails to pay. So someone is not paying for the last few months, and you are just thinking that, oh no, this customer will not pay. So this is not the thing. But what does the accountants do is they write bad debt expense debit and accounts receivable credit. Okay, but this is not supported by GAAP. Okay. So the allowance method, what does allowance method do? So the allowance method actually create a contra asset, the allowance for uncollectible accounts, to reduce the carrying value of accounts receivable to the amount of cash they expect to collect. Both the carrying value and the amount of the allowance typically are shown on the face of the balance sheet like this one. See that? So what you can see, that accounts receivable is being shown net of doubtful accounts. Can you see that? So this is how the accounts receivable is presented. Okay, and in the allowance method we will create the bad debt expense and create an allowance. So bad debt expense is not recognized when specific accounts are written up, is recognized earlier when accounts are estimated to be uncollectible, and the allowance is created. So later, when a specific account receivable is deemed actually uncollectible, both the allowance method and the specific account receivable are reduced to write off the receivable. Okay, let's have an example. A manufacturing company started operations in 2021. Okay, then in 2021 it had sales of 1,200,000. Okay, and collection of 895,000. So 305,000 is accounts receivable, okay, on December 31st, 2021. And here is the accounts receivable, the ledger accounts of the accounts receivable. So sales 1,200,000 and collection is 895,000. So we have accounts receivable balance of 305,000. So the allowance method, so the Hawthorne's analysis indicates that they will be able to collect 280,000, and that is why they are creating allowance for uncollectible, the remaining amount 305,000, and you will subtract 280,000. So 25,000 will be allowance for uncollectible accounts, and the journal entry would be bad debt expense debit 25,000 and allowance for uncollectible accounts credit 25,000. Okay, this is how we create the allowance for uncollectible accounts when accounts are deemed uncollectible. Okay, so let's continue with the example. On April 24, 2022, then Hawthorne concludes that it will not collect a $15,000 amount of accounts receivable from a customer that recently has gone bankrupt. So therefore, write off the 15,000. So here you go. So the allowance for uncollectible accounts 15,000 debit and accounts receivable credit. So if we continue with the previous example, so we had 25,000 allowance for uncollectible accounts. Now we will have the remaining 10,000 as allowance for uncollectible accounts balance. See that? So now we have this 10,000. Okay, and once we have already written up an accounts receivable, subsequently that accounts receivable may be financially solvent and they may want to pay the money that we have already written up. So in that case, what we will do, see that on May 30, the financial situation of a customer has improved and it will collect, meaning the company will collect 1,200 of the receivable that previously was written up. Okay, so in that case, what we will do, we will create an accounts receivable again. Okay, and we will credit the allowance for uncollectible accounts that we have already debited. Okay, so we are creating allowance again. So the new balance of the allowance for uncollectible accounts would be 11,200. Okay, and there are two methods to estimate the allowance for uncollectible accounts: the balance sheet approach and the income statement approach. Okay, so the balance sheet approach is based on the accounts receivable that is presented in the balance sheet. So that is why it is called balance sheet approach, and there is a new rule that is called current expected credit loss. Okay, this method is required starting 2020. So you have to analyze each customer accounts, applying an estimate of the percentage of bad debts to the entire outstanding receivable balance, applying different percentages to accounts receivable balances depending on the length of time of outstanding. Okay, and for this reason, what we will do, we will create an accounts receivable aging schedule, and from this aging schedule you can see that the age is say 0 to 60 days. This one is 61 to 90 days. This one is 91 to 120 days, and this one is over 120 days. So the more the age of the accounts receivable, the less likely it is to be collected. So that is why the percentage of uncollectible is higher for the more aged accounts receivable. You can see from here, 0 to 60 days, 5% uncollectible. 61 to 90 days, 10% uncollectible. 91 to 120 days, you can see that it is 20% uncollectible. Okay, and over 120 days, see the 40% uncollectible. Okay, there is a 60% chance that we will be able to collect. Okay, and from the accounts receivable aging schedule, So see that what we have done here, allowance for uncollectible account, that is 25,000. Okay, and now see at the end of the 2022, the company has a gross accounts receivable balance of 400,000, but believes it only will collect 360,000, so the remaining 40,000 will be uncollectible. So that, and we already have a balance of 11,200. You can remember that one, the 10,000 and 1,200. And the bad debt expense, we have had 28,800. Meaning we are creating new one because we have to maintain a balance of 40,000. So since we already have a balance of 11,200, so the difference is our bad debt expense that we need to create. So that is why we are creating another new journal entry, bad debt expense debit and allowance for uncollectible accounts credit. And from this, if the company written up so many accounts receivable during the 2022 that the adjustment account had a free adjusted balance that was a debit of $2,000, the company would have to credit the allowance for 42,000. And see that? So meaning you have to maintain a 40,000 balance. So that is why you need to compensate this one. And this is an income statement approach, and based on this one, what we will do, we will calculate the bad debt expense based on the sales. Okay, so in this example, what we can see, if the company had sales of 1,200,000 in 2021 and estimated that 2% of the sales, okay, 2% of the sales would prove uncollectible. So it would debit bad debt expense and credit the allowance for uncollectible accounts of 24,000. And this is how they calculate and create the journal.